Good afternoon, everybody, and welcome to the Nedgroup Investments Global Flexible Fund quarterly update. Realise that this is somewhat past the point of the end of the quarter, but we still feel it's really important to give you a lot more colour on how the fund performed in Q1 and what were the drivers behind that performance. I have with me today Brian Selmo, all the way from Los Angeles, very kindly got up at the crack of dawn over there, so thanks very much for joining us, Brian.
Yeah, thanks for having me.
And we had a call about a month ago, and we talked about some of the constituents of the portfolio that were affecting the performance. But I think what we wanted to do today was to go back, revisit what happened in Q1, what the team have been doing since then, and just giving people a lot more colour on what's been going on in the portfolio and how it's affected the performance of the fund. So on that note, I'll hand on to Brian, and Brian, just let me know when you want to shift on to the next slide.
Sure. So thanks for having us, and I appreciate everyone listening in this afternoon for you guys, morning for us. So I guess, quickly, when we did this a bit a month ago, and so I apologize if this is redundant, but if we quickly move to slide 2, we'll look at the performance or the major drivers in the portfolio. I think you can see there were a handful of large detractors. Each have their own story. I would try to pull them out though for a minute and talk about the portfolio generally and how it was positioned, in January, February. So we would have been a bit under 60% invested in that time period. And we would have had exposures to what I think of as the, areas that are really most at risk in this crisis of, oil and gas, retail, hospitality, let's say then aerospace, financials, just because, the last certainly not a contributor, but anytime there's a big disruption in the world, you're going to get some stress in a financial portfolio. So we don't have any exposure to retail. We don't have any exposure to hospitality. The exposure we had to oil and gas is in the form of McDermott, which we can talk more about if people are interested. But it's a debt investment that's undergoing a prepackaged restructuring. Other than that, we didn't have any exposure to oil. With respect to aerospace, though, we did own about 5.5–6% of the portfolio in aerospace parts manufacturers, Howmet being the largest position in that portfolio. That's a business that we very much like. These are differentiated. They tend to be very high share in their respective markets and earn very good returns over time. But when you have an industry seize up and stop very suddenly, those businesses are going to face a highly uncertain near-term window. What I would say is that none of the companies we own in that space, Howmet, Meggitt, and now Raytheon UTX, none of those companies, have seen their competitive position change, right? So this isn't a matter that they've become irrelevant. All of those companies have, strong balance sheets such that we would not expect any of them to issue equity to get through this period. But the demand for their products is going to be, materially impacted by the reduction in flights, and you see that in the moves on some of the stock prices. And then lastly, on financials, we are about 10% of the portfolio in financials, and those range from, banks would have been about 6 or 7%, and then we'd have another 4 or so percent in a combination of AIG and Jefferies, which are not directly banks where they've got lending operations, but they are in the space. I guess I will say that those specific areas, right, aerospace, financials, and energy in the form of McDermott, really disproportionate negative performance. I think all of those would have been down, anywhere from 50 to 70% kind of thing in the quarter and in the month. The other names in the portfolio I think of as being much less directly impacted by any fallout from the crisis, but we can define the rest of the portfolio generally as lightly cyclical or industrial in nature. And I think of that even if we range from the large internet platform companies, most of them depend on advertising. That's obviously a cyclical business, a growing but cyclical business. We have a number of building materials companies. We have some holding companies. But what we really did not have in the portfolio and still don't have in the portfolio are things that I would think of as consumer staples or naturally defensive business profiles. And the reason we didn't have those and still don't is that the multiples for those and the return prospects over a long period of time really seem uninspiring to us. And so if we think about those kind of businesses, the staples as generically facing pretty significant secular challenges, and not right now because everyone's running to the supermarket to buy their comfort food. But if we think over 5 years or something, which is the average holding period of the fund, those businesses face some real challenges from changes in the means of reaching the customer. So you go from TV or mass marketing where they dominate to direct marketing online where it's easier for upstarts to kind of get in. And then also, I think a long-term trend towards a more healthful lifestyle and eating. You're going to see a lot of, we think, headwinds for those companies. So we think of those companies as pretty low growth, not much better than population kind of growth in the West. And then they're all trading at, very, very healthy multiples up into the 20s or so. So there just really weren't a very interesting, long-term investment proposition. I think the names that we've owned, we would expect to grow more rapidly. Now, granted, cyclically, but grow more rapidly. And then also, command a less demanding multiple. So our portfolio would have been more in the, low double digits kind of multiples to what we think of as sustainable cash earnings. So that's hopefully a quick overview of both, some of the things we've owned that really were either disproportionately impacted from a mark-to-market perspective, which is kind of how I think of AIG and Jefferies, or some businesses that really have been meaningfully impacted by, the crisis and the change that it's wrought in the world. And there, I think more of Howmet and McDermott, where, the price of oil sitting around at 20 is going to impact McDermott's business. And if air travel is down, and again, nobody knows this, but if air travel is down, 20, 30, whatever percent it will be down, over the course of this year and next from where it was in 2019, that's going to just have a big impact on the demand for aerospace parts. Moving on, maybe to page 3, we did earlier in the quarter, if I think about in January and February, we would have been probably net sellers. We were then net buyers throughout March. This includes adding to existing names and increasing the number of holdings. And really, what we're seeking to do in the purchases we made in whether it was February but March also, we're looking to upgrade the portfolio in the sense that when things became discounted, and some severely for a short period in March, I think there was an opportunity to buy some names that are probably higher quality businesses, better balance sheets, and hopefully have stronger growth over time than some positions that we had that were existing. So we exited things that we would have been somewhat less comfortable with, and we would have bought things that I think we feel better about the future prospects. So that's a little bit of page 3, which has taken us to a bit more invested. The other thing that I would say, and I guess we can move on to page 4 just kind of for informational purposes, the portfolio has become more international in nature over the last year or two. So those of you who've been on these calls previously, you'll know that sort of starting in the fourth quarter really of 2018, a disproportionate amount of our purchases have been international. And that really just reflects the valuation opportunities around the world. I think page 5 just shows the exposure starting to tick up, and that's really in response to valuation. Page 6, we can get into some of the specific names here in terms of things we exited or bought bought. I think for those of you who are familiar with some of these businesses, you'll know that the things that we would have sold, things like OI, things like Arconic, we also would have sold Mohawk, Cabot, and Ally. Those are real decent, strong market share kind of businesses, but each probably have a little bit more concerns in terms of whether it would be their balance sheet in something like OI, or a transaction they entered into in the first quarter in terms of Ally, or maybe some market changes in flooring for Mohawk. They probably are a little bit less certain than things we bought like NXP, Wabtec, Univar, or Bookings, where you've got companies that have absolute dominant market share and really nicely growing underlying businesses. And then we have a few companies in there that really were directly impacted by the crisis, things like Marriott or Air Canada, where I think we think they're the best in each of their industries worldwide, but they'll have a very difficult couple years. Rob, that's a brief overview. I'm not sure if you'd like me to touch on something with more detail, or sort of change direction, but I'd be happy to either expand on anything I said or address something that maybe I missed.
Yeah, thanks, Brian. Just before I do, can I remind everyone that you're able to ask questions to Brian if you just use the box at the bottom of the screen there where it says Q&A. You can type a question and send it through, and I'll be the only one that can see those questions, so I'll pose them to Brian. But I'll kick things off then and ask you, can you just delve a bit more into AIG, because it was one of the largest holdings and it has had an outsized fall in Q1. And just what's going on there, and why do you see it still as a really good investment?
Yeah, sure. So I kind of think sometimes it's useful to zoom back to what were we thinking in January? How could you be sitting on something that's had such bad performance? Did you have a thesis back then? So very briefly, the thesis on AIG is that it is a multi-year turnaround of their general insurance business. So think about that as the P&C business. The company is made up of a couple different parts. One is a life insurance business, which has really been a pretty strong performer for a number of years. The general insurance business, which has been underperforming. And then some, what we'll call excess or legacy assets that are in wind down. And those are in the form of a deferred tax asset, and then also just a book of business that is liquidating, that they're actually transferring in the second quarter to an entity with Carlyle. And so the core earning assets are about $55 or so of tangible book. Then there's another about $10 of deferred tax asset, which is just savings you get over time by not paying taxes. So it's not really worth the full $9-10 because you get it over time, but let's say it's worth another $5. And so we would have thought about AIG as a business that was going to turn around their P&C side. Now, why do we think or have confidence in that? Well, they brought in a new management team going back about 3 years now. And the new management team, has a very strong track record in the industry. And then over the last couple of years, we've been able to see them in terms of the operating performance on an underwriting basis, and then also, particularly in the fourth quarter last year, their improvement in how the book of business that they've created on the P&C side has responded to catastrophes around the world. And so there's some evidence points that lets you get a fair amount of confidence. One, you've got the people. Two, you've got the changing portfolio that they have, and then three, you have the and when I say portfolio, the portfolio of risks on the P&C side, and then three, you've got how that portfolio is responding to shocks such as typhoons or windstorms or things like that in the fourth quarter. And so all of that lets us say that, okay, I think that AIG is going to be able to earn a competitive return. And so then what sort of would that mean? That'd be a double-digit, call it 12% return on tangible. And then we can say, well, okay, where does their peers sort of trade? Well, on the P&C side, the peers would trade anywhere from probably 1.5 to 1.8 or so times book. And on the life side, they probably trade at 1 to 1.3 times book. So if we kind of combine all that, and we'd say that, okay, you're a mix of the two. Let's say that then for you, for AIG, maybe that's a 1.3 for you. And if we look out a couple years and we say that they would have earned some money, retained some capital, let's say they will have done about $10 of earnings over that time. So you keep your $55 of book value that you're earning on, and now you're earning, you're worth 1.3 times that, plus you've got about $10 of earnings in the meantime that you've returned to shareholders in the form of dividends or buybacks, which they were doing. I mean, as recently as February, they made a buyback. And then you've got get the $5 of deferred tax asset, and again, that would be creating capital along the way. And you think about that, that's sort of an $80 or so dollar stock, $85 stock, if you just do that math real quickly. And you compare that to where the stock was, which was somewhere between 50 and 55 in the first couple months of the year. And so, yeah, if we even kind of push that out another year and say it's going to take, 3 years to get there, that kind of pencils out to a high teens return. And so that's a interesting proposition at that time. And now what's happened is that in the first quarter, you've had coronavirus, and that calls all kinds of things, into question. So the first and most obvious would be when you're a life company is, how many people are going to die? Is this going to kill tens of millions of people? And if it does, how bad will your losses be? And I think, we've now seen around the world that those kind of losses are probably less likely. One, because we've got some data on the mortality rate from the disease, and two, you've seen actions by governments and by populations to sort of slow it down. And so I think you can kind of cleave that off to the side and think that that's not very probable. The other thing that will happen is you're going to have a tremendous amount of litigation around business interruption claims, and there, we've done a fair amount of work, and AIG was pretty expansive on their call that took place an hour or so ago today. That is unlikely to be an issue given the nature of what's insured in their contract. Now there'll be litigation around it, but it would be that will be fought for years and years and years because the contracts do not cover pandemic-related business interruption, at least not in the case of AIG and most commercial insurers in the U.S. So those, I think, will be the two big boogeymen. Now, the last thing is that, any insurance company has an investment portfolio, and that's a combination of, pretty safe bonds and then also some, broad, I'd call it equity and equity-like market exposure. And, when you have what's going on around the world, you're probably going to have a difficult time for businesses over the next, year or two, and that means that investment portfolio is going to have a less rosy outcome than it would have had, 2-3 months ago. And so that's a real detriment. And so when I think about AIG, I think about, and we've got now their first quarter results were released last night, and the company had a call this morning. We've got a lot of proof points now in terms of what kind of the first two big risks are, and I think those are largely off the table. With regard to what the investment performance is going to be like, it's not going to be great. It's going to be okay. So I think we can say with a bit more confidence, just again because you've got first quarter results in, this is very unlikely to be a capital event for a company like AIG, meaning impair book value. It is going to be an earnings event, meaning the earnings power is going to be worse. So if we zoom back out to the initial kind of prospect or thesis we were talking about, the big change I would have would not be about where the company can ultimately get to in terms of return on tangible, but the earnings might be a bit different. So let's say the world is a bit different. Let's stick with our same numbers, and instead of earning, $10 over the next couple years, let's say they only earn $5. And let's say that instead of being worth 1.3 times, the whole world is much worse, right? And so the business is only worth 1.1 times the tangible book, right? And so that just reflects the fact that the whole market has re-rated. And so in that case, and if I give them the earnings power and I give them the kind of value of the deferred tax asset, that would, instead of being like worth circa $85, that would be worth circa $70. And if I though compare that to the stock price, which, you know, again, it's an opinion, but in my opinion is probably overreacted. I think the stock price is down around 25 bucks. Now, under that same, it takes an extra year, right? So it doesn't, all the math I just gave you doesn't happen in 2 years, it happens in 3 years, same as the example we gave for what were we thinking when it was at, you know, $50, $55 earlier. You know, now if I take the more depressed earnings and the lower exit multiple and I still make it last 3 years, but I'm starting with a $25 stock price, that's a 40 IRR from this stock price. So, you know, that's kind of what's happened in terms of change in market pricing. Of course, the world is uncertain. Of course, people might, you know, feel concerned and want to have a much higher return for, you know, a given company, you know, given that everyone's nervous about coronavirus. But, you know, there's some amount of what's gone on from our perspective that's a bit, you know, mark to market, and not really indicative of real big structural changes in earnings power. AIG would probably be an example of that. You know, I think that likewise we've sold some, and we've held our AIG position. And so we've sold some of some other names, like so something like Arconic we would have sold some of as kind of realization, which is Helmet, sort of a realization of how tough the environment is going to be. But that's another one where if we now think about where the stock price is today versus, you know, long-term demand to fly, you know, that probably is also setting up as a very interesting proposition. So it's another company that I will. I'll admit, I'll tell a little story now. We tried to change the timing of this call because Helmet's having their call right now also. But, you know, having read their results, not listened to their call yet, or spoken with the management team, you know, it's pretty clear that they're not going to have a existential balance sheet issue. They have some debt, but you know, they've got adequate cash, and I think have suggested they're going to be free cash flow positive through sort of the depth of this. And so you can then start to spend your time thinking about, well, okay, you know, what was my big picture thesis for aerospace 2-3 months ago? Well, it was largely premised on the idea that, you know, the developing world, and I'm really thinking where the population centers are, so China, India, Indonesia, places like that. You know, certainly Africa, maybe with a bit more time lag, but, you know, over the next decade, I would say that we would have thought that the propensity to travel by airplane in India, China, Indonesia, and Southeast Asia generally was going to be a huge tailwind for commercial aerospace demand. You know, that again, it might be a tough year or two, but if we're talking 5 years from now or 10 years from now, I don't have any real doubt in that proposition. So the ultimate demand for Helmet's products, I don't think has really been altered. And if you know, get to this place that seems like they certainly have in terms of aggressively managing the cost structure and maintaining, you know, free cash flow and a stable balance sheet through this, you know, that's another business that I think is going to have plenty of recovery. It might take a while, but it's not sort of a business where anything has come into question around the competitive position. So that's maybe a little long-winded, Rob. You're free to cut me off at any time.
It was certainly a full answer, yeah.
Apologize.
There's a question come in about what's your current exposure to global bonds, and I just reference back to your comment on McDermott, which has been one of the detractors in Q1, yeah. But I see you bought that in February, and that's linked to the energy sector, and also see you've been buying Gulfport energy bonds in February and March as well. Would you just touch on your extent of exposure to bonds, how you see where you see interest rates going in the developed markets, and whether we've reached the bottom of a cycle there, or whether that you actually factor that into your thinking when you buy bonds anyway.
Yeah, our bonds are focused on high yield and distressed credits in North America, and we're about 3.5–4% there right now. It's frankly, given the level of probable economic stress, we're a bit surprised that the bond market has traded, corporate credit bond market in the U.S. has traded as well as it has, and it's really a response to the U.S. Federal Reserve coming in and buying those bonds directly. I think that there was a couple days in March where that market locked up, and I think you can see we bought an Uber bond, and that's a company with more cash than debt, and there was a couple of these where we would bid on them, and they sort of were trading at mid-teens kind of returns. That was a very, very short period, and that disappeared once the Fed started buying the bonds. And so I don't really have any perspective on how long or where interest rates are going to be. They're certainly at prices that sort of force other action and other considerations. And by that I mean if you're getting 50 basis points or so, 70 maybe on the 10-year, and circa 1 or so on a 30-year bond in the U.S., and those are all taxable. And then those rates are similar around the world. There's just no return in that, and there's a ton of risk in it. And so I think that the bond market with any type of duration is uninteresting to us in any way. What it may push you to do as a portfolio manager or just as a person is that you may end up in some more in equities, or perhaps more in better balance sheet, cashed up type of equities, just as a place to hopefully protect purchasing power over time. If you start to worry about what's going on with bond rate suppression and money printing. But I don't have a perspective on where rates are going to be. I think if you go back, if you would have ever heard us talk about things, we are surprised and have been wrong for a decade in terms of what's gone on with bond yields. It's a absolutely perplexing situation and problem to have yields negative in some countries, but even basically zero in the U.S. It's very, very bizarre.
Thanks, Brian. And another question came through is you don't seem to have any exposure to Amazon, Apple, MasterCard, Visa. What's the reason for this? And I see Alphabet in Q1 also fell more than the index, which is where you do have exposure. So will you touch on why you maybe don't have some of those companies, and also what happened to the position in Alphabet? I think it's rebounded quite significantly now.
Yeah, look, on the first three, those are all great companies, and it's just a mistake for us not to have bought them years ago. I think that it's a thought between value and expectations and things like that. I don't have any issues with those companies as businesses. I think that they each have certain challenges, and certainly each trade at very full values. But those are among the best businesses in the world, and I wish we would have had a different idea about them when they traded at different prices. In terms of Google, we have owned Alphabet or Google for quite a while, and continue to like it and think that it has. So we think it has a very dominant position in search, incredibly difficult market, probably impossible to compete with. And then the thing we like about it is that it is very strongly cash generative, and it has a pretty interesting portfolio or opportunity set of other businesses that might be meaningful, right? And that's both, at this point they're maturing a bit, Google Cloud, and then also Waymo, the driving platform. They've got some other, moonshot kind of things, but those are probably the two that would seem like they could move the needle a bit over time. And the other bit that we like about it is the time that we've held it, it's never really traded at a super high multiple to, kind of cash earnings net of the cash and the other bets. And so, if I think about it, one of the ways we would conceive of it, I mentioned the consumer staples earlier. Well, Google is, and Facebook also, which we own, they're essentially taxes on those consumer staples or on those, the spend of societies they try to get to and reach customers. And it's both ad dollars moving there, but it's also, more traditional market activation and shelf space slotting and that kind of spend. And so it's a very big pie. And as that pie moves their way, it should underpin pretty decent growth, we would think, for another 5-10 years or so at least. And that growth in our mind is going to be much higher than the, growth of, say, the consumer staples companies. And so you can get into Google or Facebook, and I think even now, the multiple there is the same or cheaper than those other companies that face the secular headwind. Now, look, both those stocks, though, were much more volatile in the quarter than, say, the consumer staples businesses. But that's sort of, from our perspective, something we're, I guess, okay living with.
Okay, and just last question from me. You seem to be, with a few of your purchases in March, running towards the fire in the travel industry, and I guess most interestingly, from sitting in a country where the national carrier is under a bit of pressure, to see Air Canada as one of your purchases in March. Would you just talk through why that would be a good idea right now?
Yeah, I mean, I think there's a couple of things to know about Air Canada that we think make it a bit unique among airlines in the world. So number one, it's a two-player domestic market in Canada for domestic flights. And the other player, Air Canada's got about 85% share. The other player is a company called WestJet. And that company was bought by private equity, ish a year and a half, 2 years ago. And historically, WestJet had been the low-cost growth competitor disrupting that pretty, controlled market. The premise of the private equity guys were to stop that, raise price, and take out cash. If you then, layer on the coronavirus crisis, we feel pretty confident that when air travel returns, domestic air travel in Canada, the market environment is going to be very favorable. So it's an almost non-competitive domestic market, and maybe likely to be even less competitive going forward. So we think that's a neat kind of moat that the company has. Now there's plenty of competition coming in and out of Canada, right? So on international kind of flights. But Air Canada's got a pretty good position there also, and part of the reason they have this good position is I mentioned they got the dominant share in country. Well, so what that affords them the ability to do is offer a loyalty plan to the domestic audience, and it's like Air Canada miles, right? And so it's a credit card, and it's a dominant rewards plan in Canada, and so that's a business that, one, kicks out all kinds of cash to them, like a Visa or MasterCard, frankly, because they get a share of the spend on those cards without having any capital at risk. And so they don't own the network, they don't own anything else, but because everyone wants the rewards on their operation, meaning being able to fly on vacations with the miles that you accumulated for flying for work, they are able to extract economics in that. And that's a business or a revenue profit stream that should be a little bit less impacted. It'll be impacted because the economy's down, but a little less impacted. And then that also means that their share flying internationally out of Canada is a bit I'll call it advantaged versus others, whether it's United or whomever else is flying in there from the U.S. for the Canadian audience. So they got a neat mousetrap for the Canadian traveler, and then the other bit is they are the best, maybe Ryanair, but they're among the best capitalized balance sheet-wise airlines around, and so they have a very long period of time they can survive without revenues, or with de minimis revenues. Now, they can't survive forever, though, and so there's certainly some risks, and we will, need to pay a bit of attention to Air Canada, because if this goes on for years, then they're not going to make it, and so it's not a very large position. It's a position that we are, continuing to evaluate. They also announced results, I think it was yesterday, and it looks like they'll have about a year or so of runway if there with no recovery in the operations. And so, I think our bias is that there will be recovery in the operations before then, but it's something we've got to think about, and we've got to kind of continue to assess. And so I would say that Air Canada is probably on the, if I think about the things we bought in the quarter, it is the riskiest in my mind. And it's also not very large position, so it's, I think, less than 50 basis points.
And then Marriott International, then, is that equally, or is that quite well capitalized?
Marriott, I think, is a little bit less risky, just because the point at which Marriott, for those who don't know, Marriott's a hotel franchising business, and so they're the franchisor, and so they don't really have capital to speak of in the hotels. They just get paid a percentage of RevPAR. In some of the hotels they manage, so they get paid for the staff directly passed through. Marriott has corporate net debt. The issue with Marriott is their break-even points from a free cash flow perspective. It's less than 30% of RevPAR, meaning RevPAR could be down 70%, and Marriott kind of is okay. We all have to make assumptions, I suppose, about what travel will look like and things like that going forward. But even in the depth of this, in a lot of categories in the U.S., you are still in mid-teens to 20%, kind of occupancy. You're not at the big, the luxury resorts or something like that, but in sort of the core bread and butter mid-scale hotel, so our guess is that you're not going to have more than a quarter or two of kind of operations at Marriott that are below free cash flow positive, and in that case they're really fine. And then if you think longer term about a company like Marriott, it's one of the great businesses in the world, and that they take a fee off of hotel room night stays, and their reservation system is strong enough that it drives incremental stays at hotels, meaning that the owner of the hotel gets a good deal from paying them the fee, which allows them to grow on the back of more owners wanting to get that good deal and drive economics to themselves as hotel operators. So Marriott and Hilton will dominate the sort of pipeline for new hotels, and again, in the fullness of time, I think that's a growth business, and is pretty attractive to grow on the back of someone else's capital. So we were very much like Marriott, and look, Bookings is the one that was the largest of those, and so Bookings looks a bit like Marriott in that it is a tax on room nights, but there it's the online travel agency, and it though is it's taking that on independent hotels instead of the branded ones, and so it's a bit different. It's more of a international focused business where there are more independents. And why Bookings is the largest of those names is Marriott and Bookings probably traded a similar valuation, but Bookings had a stronger balance sheet, and so we just felt more comfortable being in more bookings, essentially.
Okay, thanks very much, Brian. I'm just going to flick onto the next slide, which shows the asset allocation position of the fund as at the end of March, which was around 34% cash. Are you still around that level at the end of April?
Yep.
Yeah, so I assume with the markets rebounding 30% from 24th of March, a lot of the bargains that had come through have dissipated again. Is that right?
Yeah, I think that's right, and I think also, I mean, look, there's a huge spectrum of unknown in what's going to happen economically, and I think that the chance for a very difficult economic environment, particularly, it's harder for me to talk to other countries because everyone's probably handling this a little bit differently. But the U.S., there's going to be a big adjustment here, and I don't think any of us know really exactly what that means or what it's going to look like or how long it's going to last. So I think the option value on money is very very valuable right now.
Okay, well, thank you very much, Brian. I really appreciate your candor and your extensive answers on some of the companies that you own, and I appreciate your working tirelessly to ensure the portfolio's rebounds as expected.
We appreciate your guys' support, so thank you.
Thank you very much, and for everybody who dialed in this afternoon to listen, thank you very much. Appreciate you spending the time with us and listening to what we have to say. A quick reminder that we have 3 more global calls this week with Tony Cousins from Perford on our Global Cautious Fund tomorrow morning at 10 a.m. We have Global Property on Thursday morning at 10 a.m. and Global Emerging Market Equity on Friday at 10 a.m. as well. So please join us once again later this week, and thank you very much. Have a good rest of the day. Thanks a lot. Bye-bye.